Fantastic. Okay, Adam, thank you very much. Good morning, ladies and gentlemen. Again, I'd like to sort of set the scene for today's discussions on the unconventional world of resource, tell you about some successful companies, tell you about the US successful case of shale, the international story so far, what do we see happening. Then I want to look at some good strategies, some bad strategies in terms of shale exploitation from our particular vantage point. And then some of the benefits from actually getting shale correctly positioned within one's portfolio. So there's a number of real positives that we see coming out the other side. And then we'll just conclude quickly. So if we jump into this first section, you will be very aware of this. Firstly, this is the successful case of shale gas inside the US, and it's a function of this portion of supply, which has really, increased from 25 billion cubic feet per day. This is tight gas in the light blue, and this kind of green-gray shale gas has increased from 2009 all the way through to 40 billion cubic feet per day, roughly at the end of last year. So all of this section here, and you can see, sorry, my laser pointer is not working that well, but you can see the red line is the gas price. So as we've added almost 7 million barrels of oil per day in terms of oil and gas equivalent, you've had a clear reduction in the US gas price, and it's been capped at around $4 per MCF. So that's kind of well known, well understood. This shale gas is very low cost. It has displaced much of the need for the black area of this chart, which is the lower 48 offshore gas production. Many of those fields just declining, probably not too much development in that particular portion of supply. The onshore conventional has stabilized as people go back into those wells, reactivate them, do some horizontal drilling. So you can see the declines have stabilized in terms of the lower green section. But principally, this incredible increase over 6 or 7 years has caused this remarkable price decline from 12 from 14 down to 4. So that's kind of what we know. The very same thing has been happening over the past 5 years in terms of oil, in terms of liquids. So same typical chart here, crude production at the bottom, you have your natural gas liquids, and then you have this emerging chunk of supply, tight oil, shale oil, which has become 3.5 million barrels per day of new black oil in the system just over the kind of 2010 to 2013 period of time. And consequently, this too is causing a price dislocation. So the red line being WTI, as you're fully aware, has delinked and moved away from the yellow line, which is Brent, the kind of international oil price. So again, having a very profound impact on the localized oil price. So clearly, both of those commodities are cheaper, leading to all the industrial improvement, the kind of lower input energy costs that many of the companies in North America are talking about. So that's what you want to see internationally. That's what you want to see rolled out elsewhere. In terms of the US story, before we go into the companies and what's happening, I mean, we still think this will continue. So this is just the kind of US picture again, going back through time, according to some of these different basins, the Permian here, the Eagle Ford, the Bakken, other shales, all really stepping up here quite materially. And we think probably they will still keep growing until 2017, 2018. So we have another 3-4 years of growth still coming from that resource base. After that, we think it might plateau. Others think it will continue to grow. The jury is still out. The second wave will be about technology application, about enhanced oil recovery, etc., etc. So that's where most of the discussion is. This easy increase, well, not easy, but 3 million barrel per day increase has happened. From here you can see the rate of change is slowing, at least according to the current models that we're running, and maybe it peaks by 2017. But lots of new information is coming in, it's very new, and it's probably quite foolish to say that would be the actual peak point. But clearly, in the context of history, a remarkable success story. And I think another way just to visualize this is just to think about who did this and how does it compare to another area like Iraq, because Funny enough, in 2009, you have 500 smaller mid-cap operators in the US going after shale oil. And they've added a kind of 3+ million barrels per day of black oil here, which I'm just showing you here. This is again US oil production. And then the interesting thing is, if you go and take Iraq, because all of the Chinese, Russian, Western, European and US integrated oil companies, plus some smaller companies, totaling 50 companies, entered Iraq and tried to grow that production from 2.5 million barrels a day to a target of 11, 12. And you can see over the same time period, we've added 0.7 million barrels per day from the biggest set of operators within the industry. And this was pre-ISIS. Okay, this was a more benign operating environment in this period of time, but still only 0.7 relative to the 3 years. So I think that's another really interesting way just to depict the success of this increased oil supply. And of course, it's not just about the resource underneath. I'm sure many of you have seen different tables like this. It is a clear function of all of the above ground dynamics. And you really have to put all of these in place, make sure they are aligned in order to get, we say, overall success score. And they are. Water availability, gas pricing, needs to be transparent, needs to be kind of deep liquid market. You need a favorable regulatory regime. Clearly you need service capacity that's capable of delivering this. You need a labour force, and you need, as I was kind of alluding to, a significant number of independent operators. And when you kind of stand back and view the world and say, where do we get these most aligned, clearly the bottom line is the US, and we're kind of saying yes to most of those, which is why it has been such a success story. So you can see that at the moment, all the other countries where there are source rocks or are shales, we're not quite getting all of those in place at the moment. So there's still work to do. Not to say that none of these can become closer to this over time. But this is the current state of play as we look at it today. And then I think it's useful to step back one more step globally and look down and say, really, it's a truly incredible success story. This is just non-OPEC oil production. And giving you 10, 11, 12 years of history. And really what I just want to highlight here is, the world was relying on Russia. These black chunks, the black vertical bars here from 2003 really through to 2010 was just Russia coming back, adding supply into the markets and really helping to balance the demand outside of OPEC. And obviously Russia has kind of reached its limit at the moment in terms of how far it can go. They have a shale up there as well. But in the last couple of years, the kind of light blue area here is the US shale liquids. And you can see it's really been adding 1 million barrels per day plus of this every quarter, and really helping to offset the slowdown of the Russian FSU supply. So oil prices would have been materially higher if it had not been for this success case in North America. But I think that, it's also, as we kind of look down here, just to remind ourselves, is it yet altering the cost structure of the industry? Is it like shale gas, which has? Is shale liquids doing the same? That 3 million barrels a day into a 90 million barrel per day oil market, are we seeing any real improvement in industry margins, industry costs, of which to get very, very excited? And this is just really, a kind of bar chart showing 50 of the largest companies globally, and really all you have to look at is the black line at the bottom, and we've had shale oil since 2009, 10, 11, 12, 13, but industry margins, hopefully you can see from this, have not yet improved markedly from the introduction of this new supply source. So again, that's the point. Questions are still, kind of the jury's still out. Is it high cost? Is it average cost? Is it low cost supply? From this, at least entering the global system, it isn't actually low cost. It's probably high to average cost supply so far. Okay, so that's clearly a very clear success story. Let's look internationally and see what's happening in the rest of the world. So, we showed this chart without without the unconventional additions a couple of weeks ago, this is conventional deep water, shallow water, onshore discoveries in blue, and then deep water in black, all the way through time. And then we can try and just stick on top so-called unconventional resources. Now these are technical resources. This is still tight gas, tight oil, and shale as well. So you can kind of see where people have claimed it's a very tight resource, and increasingly through time, some of the shale resources are being touted, being discussed, whether it's China, Poland, India, Argentina, Australia, etc. And they're starting to have a little bit of a noticeable impact on global discoveries of resources, but clearly not meaningful yet. In fact, I think, just to give you some numbers, so the last 10 years has been 20 billion barrels oil equivalent in terms of adding up these little green stacks. But that's about 3% or so of the total oil and gas discovered in this last 10 years. So again, and by the way, this is just international, so still quite small in terms of the technically announced numbers. Okay, I mean, obviously there are increasingly well-rounded frameworks in which to identify potentially successful shales, and I'm sure everyone has a different framework, but there is, very simple ones like this, the kind of organic carbon, the scale, the size, the depth, the pressure, and the clay content. So you can do very simple analyses like this, and you can start to see which ones pop out of the top. And I think increasingly, many people kind of point to Bashanov, Russia, backward to Argentina, Baltic Basin, parts of the UK, Sichuan Basin, China, Cooper Basin, Australia, Tarim, China as well. So these are kind of some of the initial basins which popped up on radars, and naturally, therefore, when you look at the bottom exhibit, excuse me, this is where you're seeing the greatest number of wells, exploratory wells, being drilled for shale. So Argentina, 150 wells so far, China about 100, Poland 40, and then you can see the tail of wells having been drilled elsewhere. So still very, very small numbers so far. Just put that in context of kind of 14,000, 15,000 wells drilled each year inside the US. So we're still very early in kind of uncovering where the sweet spots are and which of these shales is actually going to be quite prolific. And it's obviously useful to keep a track of which well results are publicly released. And this was just the case of Poland, which was, if you go back to 2009, it too was launching a major shale gas exploration phase. And you can kind of track flow rates in kind of millions of standard cubic feet per day. And it was ranging from 2.3 down to 0 in some cases. And unfortunately, the sustainability of some of these flow rates were initially 2.2 million standard cubic feet per day, but ultimately started falling quite rapidly to these much lower levels of production. And just to give you a sense of the kind of average flow rates, were consistently coming out of the US shale gas plays, then you can see the numbers here of minimum to up to like 14 million standard cubic feet per day. So we haven't yet, in this Polish Baltic Basin, find a set of repeatable results which is matching some of these commercially economic shale gas plays in North America. So that's just a little bit of a glance at some of the well results. And that's disappointing because when you look at Europe in terms of its supply forecasts, these are some supply forecasts in green for European shale production that we were making back in 2007. And again, we used that little matrix of alignment of key success factors in order to say, is this going to happen in a kind of meaningful time period? And at that point, we didn't feel comfortable in saying yes to that question, so we were still expecting some declines here, ultimately getting to 127 billion cubic meters of production next year, 2015. And I guess as we stand in the final quarter of 2014, I think next year we're going to end up at 130 billion cubic meters of gas production in Europe. So not too far away, really telling you that despite that period of time, we haven't added any increased gas production, certainly from shale or actually elsewhere. The blue line here is obviously European gas demand, which has subsequently decreased through the great financial crisis, and that's more of the industrial demand that's been taken out of the system. But it was the supply side of this exhibit I wanted to highlight today. Okay, so what about elsewhere? Well, the one area where it is looking a bit more promising is China. And you can take China and you can start to think about the young rocks, you know, in the east versus older rocks to the west, and you can think about the kind of marine kind of rocks in China versus non-marine, and you can zoom in on the kind of southwest of the country, the kind of Turin Basin, which we saw screened well in one of the previous slides, but also the Sichuan Basin here, which you may have heard about. And again, that's the key focus area for shale gas exploration in China at the moment, and kind of fits the kind of right age, the right shale, and naturally that's where we are seeing those wells being drilled. And there is some gas production data coming out of the companies. So these, I mean, they are kind of constrained flow rates, but you can see these two well examples here. So there is gas coming out. It is shale gas, and it is flowing. So it is successful. I mean, I think there's 27 reported gas wells overall, and the average of those on the top exhibit here is about 4 million standard cubic feet per day. So a much healthier, sustainable flow rate than what we've seen in Poland. So that's, again, a good start. And even when you kind of plot things like initial production here on this y-axis, and the kind of estimated ultimate recoverable resource from these wells, you find these kind of linear correlations. The Chinese well results, I mean, within the green band, are kind of stacking reasonably well versus some of the North American shales which are working. The only side which still has to improve is this green circle, which is the well cost. Ultimately, you can see it is meaningfully deviated the well pushed to the right here in terms of this correlation that we find in North America. But at $12–13 million per well, they have to get that much lower, down towards kind of $6–7 million per well level. So that's the challenge that China is currently working on to bring those costs in. So the flow rates seem to be reasonable, but the costs still have a bit of work to do. So China kind of looks very interesting from our perspective. The other area we saw was Russia. I guess, you know, it's always interesting just to go to Russia. I'm sure many of you have been there to West Siberia and have seen it, but you know, just to give you a sense of currently in Russia, in the US, frac jobs, you know, unconventional frac jobs look like this. You know, with all of the rigs and the pumping, you know, vessels that are installed. And then when you come into Russia, this was a Gazprom net well from 2 years ago. Just gives you a sense of what's happening there relative to kind of a typical US frac job. And then you just have to step away and think about the repeatability and the ability to kind of move across land and kind of get this manufacturing-led production growth, which is the case here. And you just step back and think about West Siberia, and will it be conducive to doing that? So I think that some of those pictures might paint the picture of probably it's going to be a bit more difficult, at least in the summer months. But the other thing that goes on in Russia, which is very important, is the fiscal regime. You saw fiscal regime was on our matrix back at the very beginning. You might find people talking about unconventional wells in Russia at the moment that make very high MPVs per well. Right? Initially, let's say $92 oil prices, making $4.5 million per well, positive MPV, which is a good thing. And if taxes were decreased, which are these next set of blue lines, so as some of the taxes are removed in Russia, obviously the value of that operation increases markedly, and certainly increases more depending on the oil price. I think what we found so far is that some of these wells, which within the Vashenov suite, are kind of just natural fractures that are being drilled and are flowing. So there's not actually a lot of stimulation happening. So, and they're not so repeatable. I mean, you can run your seismic and you can identify 30 or 40 locations, and that's really what you have to play with. So quite a constrained universe of wells in order to kind of capture this kind of economic upside. The true shale, you know, the true Vashenov shale, which is deeper and still needs to be delineated, would have economics a little bit different. So probably an order of magnitude less MPV per barrel, which is an 0.4 here at $90 from the lower permeability bashing off. So at the moment, it does need, clearly, tax decreases. It needs the Russian government to say, we will give you the visibility of almost 50 to 100% decrease in mineral extraction tax. So that's, that is a big issue, certainly today, with the Russian government, with the Russian reserve situation, with some of the companies asking Russia for access to the reserve funds, and then for the government to go off and say, we want to start collecting tax receipts on this new kind of Bashanov, the kind of shale play. So I think it's going to be a very difficult situation to say, this is the unit economics, we're going to see a lot of activity happening very, very quickly. And I think the other thing just to remember about Russia so far is they need to stabilize the brownfields and then to have sufficient cash flow to go after the shale operations as well. Because as you may know, West Siberia has been in operation for a long time. This is just taking one company, it's Lukoil. The green lines are year-over-year oil production in West Siberia. And of course, we used to have very strong growth periods back here, of 4, 5, 6, 7, of 4, 5, 6% per year. And CapEx, so the amount of money they're spending to do that was the red line. And it's over this axis, which is about $2 billion per year. And you can see that, over the past decade, that $2 billion has become $8 or $9 billion. And, we get some little periods of growth here, but they're clearly quite difficult to sustain that level of production. And that's clearly having impacts on that available cash flow that could be allocated into the shale Bashanov suite. So, it's not just we have the shale, we start to align those factors like fiscal take, like rates, and suddenly we can expect a success story in terms of Russia. And in terms of the last one, it is Argentina. You are seeing companies go in. I really don't have a lot to show here because I don't have any real data that's kind of meaningful at this point, except we are at least seeing a step up in the rig count. That's clearly 50 rigs has become 100, so there is a bit more activity. Not really much to show in terms of volumes. But remember 100 rigs. You remember the US runs 2,000 rigs and has added that 3 million barrels per day of production. So you can also do little calculations of the number of rigs per play equals potential output. And this level would need to be stepped up quite materially to think about material oil production. So, I think hopefully that said a little bit about the international shale case so far. Still early, still a lot of work to be done, and I think it's going to be something we need to keep watching for the next couple of years, but clearly going to be very difficult to replicate the US case. Okay, then I want to just step in and say, what have I seen from some good shale strategies from companies that I monitor quite closely, and some where it hasn't been so successful. But before I do that, I just want to really show you how kind of the US oil shale contribution to the cost structure, because I mentioned globally it's not decreasing costs. But inside these US companies, it's having a very positive effect. So this gray line here, you can see it, is the percentage of liquids in production. So kind of since 2008 here, 2009, you can see it's been steadily increasing as the whole universe of companies shifts into shale liquids. Obviously it has higher margins. And then the stacked bars are the cost structure. So production costs, OPEX, depreciation, exploration expense, and kind of other costs. But you can see versus the trend from 2004 to 2008, which was steadily up, which was a kind of industry trend. Post the introduction of shale liquids into their production mix, you can see how stable their cost structure has become. So that's a very positive effect for this group of companies. Okay, but again, they are smaller to kind of medium-sized companies that are actually benefiting from this trend. Okay, I want to take two companies then. I want to look at Statoil, which I think has had a very good shale strategy. It identified this particular opportunity, and rather than just really take positions in every shale play, and there were lots at the time, they really took an idea on the Marcellus gas, the Bakken liquids, and then the Eagle Ford kind of liquids and gas. And it's really just a title that kind of says it all about these next two charts. Is they spent really $12, $13 billion. Today, he's delivering 200,000 barrels per day of oil and gas. And the green is gas here in Marcellus, but it's in the northeast part of the US, and it's clearly benefiting from much higher differentials than the Henry Hub gas price. And they have all the capacity they need to exit that gas to market. And it's about 12% of their total production. And it's happened in 3.5 years, which is, really quite impressive to add 12% in 3 years from this very predictable kind of growth opportunity. So I think, and ultimately, these three shale plays are deemed to be three of potential best in North America. So those are the three they kind of got into over this period of time. So this was much more focused, watching companies first, joint venturing with them, and then launching a bit more of an acquisition and development-led strategy afterwards. In contrast, you had Shell, which was very different. They were really looking at, I think, like an exploration campaign, saying let's take land everywhere, and let's maybe drill it all out, and maybe we get 30–40% exploration shale success over time. Because what they did was really invest $26 billion, so more than double Statoil. Ultimately today it's about just shy of 200,000 barrels a day, so the same as Statoil. But it took about 6+ years to get there, so double Statoil. And it's only about 6% of their group production today, so half of Statoil. And it is, in the top three buckets up here, primarily natural gas. There's a little bit of liquids coming through here in terms of the last 3 years. So I think that was a very different one. Take land everywhere and spend capex, spend money on all of these shale plays, but it felt more like an exploration campaign. But unfortunately, doing it that way has caused irreparable damage to one of Shell's highest returning businesses. I mean, Shell used to make over 20% returns in the upstream Americas business. And because of what happened in the strategy, you can see in the top chart, the 20% became, 10%. At least in 2013, it was 10% return. And that was really a big function of this. I mean, I'm going to show you what they're doing in a moment, where I think at least we can see some improvement from this point onwards, but it'll be very tough to get back to the 20% plus returns that they were delivering before. The bottom chart is just, the net profit that this business was generating was, $3, $4, $5 billion a year, and you can see the last 5 years they've really struggled to make any money at all. I mean, that's really quite incredible. So, I mean, this is obviously a big management distraction. It's at the moment a big cleanup story. It's a big fix-it operation for Shell. That is a lot of management distraction. The initial part of this was to impair assets. So you've seen, certainly last year, almost $5 billion worth of impairments. So you spend 26, and a couple of years later, you start impairing. That's obviously not good for a shareholder. And then you can see, this is currently what's kind of going on, or at least my kind of view on what's happening. All the red areas, they're kind of getting out of, exiting very, very quickly, if they can find buyers. And when you kind of plot their well performance in blue, and then just rank it into deciles versus peers in those shale plays, you can kind of see that, in this one in Pinedale, they used to be a very high performer, but recently, the top decile performance has dropped to 7th, and I think this one's going to be a kind of exit strategy. Equally, the Utica used to be 7th decile, has increased more recently to 4th, and they're actually going to stay in a more focused area of the Utica. Some of these are kind of mid-decile, they're keeping bits and pieces, and you kind of see them in Canada where they have some good productivity shale opportunities, which could link into LNG opportunities. So you can see what's happening, but this is a big, big operation that's currently ongoing. So I kind of put that in the bad shale gas strategy bucket. Okay, then I'd like to just show you some of the benefits from getting it right. And the first thing is obviously if you invest in one of these companies, or you're a shareholder, or you have options in one of these companies, then the equity stock market is going to be very pleased with you if you get it right, because over the past 3 years, North American E&P companies, the guys delivering this, are up 30%. So that's not a bad kind of return over 3 years. And linked to that, North American oil service companies feeding into this, delivering and cut down almost as well. And then you start to look at the rest of the energy opportunities that are kind of out there. Integrated oils, 15, European oil services, 12. They don't really participate that much. You know, but then European E&Ps. I mean, this is the big issue with the European E&P model. It's much less predictable growth. It's much longer duration investment cycles, much longer duration payback, etc., etc. And you can see how that kind of gets reflected in share price performance. And equally, if you're in emerging markets, then that's been an area that hasn't done so well. And obviously, this is kind of a period when oil prices were relatively flat, as you've seen. So this is clearly the shale success story that has delivered this. The other benefit is, I mean, is how quick the production can come. I've kind of alluded to that in some of the previous charts, but this is the Eagle Ford in blue, and this is, our estimates of the pre-salt Santos Basin production that's going to come through as well. And you can just get a sense here, you just think at the 1 million barrel per day level here, which will really come in Eagle Ford after 3 years from all the operators. But to get 1 million barrels after 3 years versus, what is probably one of the best offshore resources today, the Santos Basin, and they're really going for it, but still, it's going to take 6 or 7 years to get the equivalent volume out of the Santos Basin. So this is starting to become very, very important for investors. Equally, it's not just how quickly your volumes come, but all the kind of unit metrics seem to look pretty good as well. So, if you're thinking about how much cash do I get back for every barrel I produce after costs, it's $35 in Brazil, but in this Eagle Ford, it's slightly higher, 39. So it's very attractive cash flows as well, and certainly versus some of the larger diversified portfolios at $28 a barrel cash flow per barrel. So again, this stuff screens very, very well, and that's it's no wonder many of the companies would love to have a piece of it. And then the other benefit, again, I alluded to, is the cost structure. So if you have it in your portfolio, you might see kind of deflationary impact on your cost structure. So you just look at the green line, or this is Canadian E&P companies in blue, national oil companies in black. The green line is US E&Ps who have it, and you can see over time they went from the highest cost bucket to last year when they were just second lowest versus international E&P companies. But you can see over time how that's kind of trended versus the rest of the lines, which still seem to point upwards. So again, it's a very attractive kind of shale resource here. So those are the clear identifiable benefits. So I think it's something we're going to keep talking about. We want to see it happen internationally. But just to conclude, I think North America is clearly a phenomenal success, but it has been half the story has been those outlier factors. We need to have those in place. The increased exposure to the US shale liquids is having a remarkable dampening effect on cost structure in large portfolios. And if you have it, you can constantly deliver predictable kind of material production growth in shorter time periods than conventional fields. So it's giving investors an entirely different opportunity set. International shales so far is remaining a little bit elusive outside of China. Certainly, at the moment, the small companies have proven to be more successful than the large companies. And if we look at some of the strategies, then the more focused watching and building in concentrated areas has proven to be more successful than looking at this like an exploration strategy in the case of some of the larger companies. So hopefully that's a little bit of insight to how we see the shale opportunity globally, and I'm sure the rest of the speakers will give you a lot more detail on how to find it and how to develop much more efficiently. But thank you very much for your attention, and I'll stop there.
Does anyone have any questions? No? Sure? Okay.
Sorry, one question.
Morning, Rich Whalen from JX. Just commenting on those numbers, just an observation on the Statoil good story. I recall that they were looking at shale in North America well before 2011.
Yeah.
And even they've had some significant write-downs. So yeah, I agree they focused. But I think in general, the big companies have been so late in their own backyard, and they're doing the same thing in Europe, or have been over the last 3 or 4 years.
Yeah, no, that's true. I remember the first acquisition they did, Statoil, looked expensive relative to multiples at that time, but then obviously it became more attractive, the liquids component in all of these shales. So today it looks like a good deal. At the time it looked less attractive. But they were looking, they all looked at gas, but Statoil have been able to move into liquids quickly, like the US E&Ps, where I showed you that chart, how they really ran quickly into liquids predominantly. So they kind of followed that trend. And I think the gas could have been Haynesville gas, which is, I think maybe to some of your point, a lot of the integrateds have been in the Haynesville gas, which is pure dry gas, with limited way to monetize it and capacity. But Statoil's gas is Marcellus. And I think the one thing I would say is they had their commercial teams also make sure they had the exit capacity. So you may know that they full rite of passage into Toronto, full rite of passage into Manhattan, and there you're selling all your gas at some of the highest prices in terms of gas prices. So it's, it may be gas, but it's actually some of the best natural gas shale to have.
Francis Jones. Did I see that you had on a slide just towards the end something about it being less risky production? But the story that you're telling about Statoil and Shell would suggest that Statoil waited until it had been de-risked and Shell didn't, and therefore that would tend to suggest that actually it's quite a high risk.
Yeah, I was meaning it more geopolitical in terms of the risk from that aspect. I mean, you can see that in the share prices of E&Ps delivering shale and production growth in North America versus E&Ps in Europe. If you take Tullow, I mean, you're really saying, I'm going to double my production over 5 years. Production will come in year 5. I have to spend $10 billion in Uganda and Kenya to get that cash back. That's what an investor has to believe. And in those 5 years, so the government's not going to change the terms and everything moves smoothly. That's becoming a tougher proposition from a risk perspective versus a US E&P who's saying, I will grow 10% a year for the next 5 years and spend comparable money, and it's under my feet. I can tell you it's here. The US fiscal regime shouldn't change too much, and you can see those companies increasing the dividends every year as well. So it was more of that distinguishment between shale being less risky in North America versus conventional Africa. But to your point, I think you're right. But what you're seeing with the integrated oil companies today is they're recognizing that even though they take an organic position, the corporate structure, the overhead is too big, too slow to make the quick decisions. So you may have seen that Shell and BP are actually creating very separate US conventional businesses, with separate CEOs, and to make them smaller, more nimble, and to act like those US E&P companies. But to go in as Shell did and just take land without really knowing that the kind of lay of the land was ultimately turned out to be high risk.
Tony Grindrod, APG. Oz, could you give us some insight into where you would put Devon and Chesapeake in that sort of spectrum, bearing in mind their recent financial results? But they've been around for quite a long time.
Yeah, it's, I guess I mean, from a shale perspective, you will find investors think a company like Chesapeake has been, very successful over time. And this current CEO has his new company and he's kind of doing it again. And again, that's very attractive if you can get in at the right price. But I guess at the beginning it was very much natural gas. Gas prices were decreasing markedly. Yet these companies, like the two you mentioned, were potentially still spending heavily in the gas, even as the gas price was declining. So I think that was always one of the issues. It's like European refining today. Everyone's losing money. Everyone was losing money in US shale gas, but some of the biggest producers, whether it's European refining or US shale gas, didn't decide to curtail production, and you would have brought the price back up again and really helped overall industry margins. So I think that was part of the tainted view of those companies at the time. But accessing the shale, a big tick, they did fantastically well.
Got one last question.
This is Clint from KGOC, which is a great oil company of Gulf GCC stuff. You have mentioned in your slides that the Iraq oil production. So what we know, or basically what I know, is conflicts that raise up the oil prices. And in the situation of the GCC countries and the Middle Eastern countries is prices are really going down. And I really want to know if there is a conflict in that area, such as Iraq, Syria, and Yemen as well. Shouldn't those conflicts raise up the oil production prices? I mean, the daily basis ones and the production itself. And what are the reasons of getting those prices getting down? That's the things.
Yeah, I mean, I wanted to be clear that the Iraqi production increase was kind of pre-Syria, pre-ISIS. It was more how the operators did in the same time period. So I'm making that distinction. But to your point, I think the reason all of those events you're mentioning aren't inflating the oil price is a big function of this. This is very easy to bring on North American shale supply. The higher the oil price goes, the greater the range of inventories of wells that these companies will start talking about. This area becomes economic the higher the oil price goes, and they keep drilling. So you have, like, as we said, kind of natural thermostat in the system. So geopolitical events probably won't have the same impact as they did back here until this growth kind of fizzles out. And that could be the end of the decade. And that's really what's happening here. That's why it's just not having an impact.